Welcome back to Boni's Life, the only place where we decode the crypto matrix without the noise, without the hype, and with just enough caffeine to keep us all sharp. If you are new here, hit that subscribe button because today we are looking at a market that is currently flashing extreme fear, yet institutional money is quietly building the rails for the next massive run. We have a lot to cover. Bitcoin's critical inflection point, a massive week ahead for macroeconomic data, and the regulatory catalysts that could either open the floodgates or delay the party until 2027. Let us dive right into the technicals. Looking at the past week, Bitcoin has been testing the nerves of even the most seasoned traders. We are currently sitting right around $66,850. Over the last 7 days, it has been essentially flat, up a microscopic 0.2%. But do not let that sideways action fool you. Beneath the surface, the market is a coiled spring. We are trading above the 50-day moving average, which is bullish, but we are trapped below the 200-day moving average. This is the textbook definition of an inflection point. On the 4-hour chart, we are seeing what looks suspiciously like a bear flag forming. The MACD histogram on the daily chart recently hit minus 639, which is one of the deepest negative readings we have seen in months. What does this mean in plain English? It means the bears are trying to pull us down to the $63,000 level. But the bulls are fiercely defending the $66,188 support. If we break below $65,500, expect a quick slide to $63,000. But if we can secure a daily close above $68,400, that bear flag thesis is invalidated, and we are looking at a clear runway back to $70,000 and beyond. Now, let us zoom out and look at the global events shaping this market. The coming week, starting April 7th, is an absolute gauntlet. First, we have the US Consumer Price Index, or CPI, data dropping on Friday, April 10th. Inflation has been the boogeyman for risk assets all year. If CPI comes in hotter than expected, the Federal Reserve will have even more reason to keep interest rates elevated. Speaking of the Fed, the market is currently pricing in zero rate cuts for 2026, a stark contrast to the optimism we saw earlier this year. We also have geopolitical tensions, specifically around the Strait of Hormuz, pushing oil prices above $110 a barrel. High energy costs directly impact Bitcoin miners, and we have already seen the network hash rate drop in Q1 as miners struggle with profitability. Furthermore, the US dollar index is hovering near the critical 100 level. A strong dollar traditionally creates headwinds for Bitcoin, but it is not all doom and gloom. In fact, the institutional side of the equation is incredibly bullish. Just last month, the SEC and CFTC officially classified Bitcoin and Ethereum as digital commodities. This is massive. It provides the regulatory clarity that Wall Street has been begging for. We also saw Bitcoin ETFs end a 4-month outflow streak with over $1.1 billion in inflows in March. Franklin Templeton is launching Franklin Crypto, and Solana is now hosting over $1.7 billion in real-world tokenized assets. The infrastructure is being built right in front of our eyes. The biggest catalyst on the horizon, however, is the Clarity Act. The Senate Banking Committee is targeting a markup for this bill in mid-April. This is the first major U.S. crypto regulatory framework to move to the full Senate. If it passes, it opens the institutional floodgates for altcoins, particularly XRP and Ethereum. If it stalls, we might be waiting until 2027 for meaningful legislation. We also have some significant token unlocks this week, including 40.6 million ANA tokens and 9.9 million HYPE tokens, which could introduce localized selling pressure. So, what are the experts saying? Goldman Sachs analysts recently noted that based on on-chain metrics, Bitcoin is near its bottom, citing institutional accumulation patterns that suggest a floor is forming. And meanwhile, Coda Trader's latest analysis points out that while April historically averages a 33% gain for Bitcoin, 2026 has already defied seasonal trends. Their advice? Don't trade the calendar, trade the levels. Even Jamie Dimon at JP Morgan is signaling interest in prediction markets, showing that traditional finance is still hungry for Web3 innovation. How do we trade this? Here is the strategy for the coming week. For Bitcoin, patience is your best friend. Do not front-run the breakout. If you are looking to go long, wait for a confirmed daily close above $68,400. That is your signal that the bear flag is dead and momentum has shifted. your target would be the recent highs near $72,500. If you are playing the short side, a break below $65,500 opens the door to $63,000. Set your stop losses tight, right around $67,000, because volatility will spike around the CPI data release. For the altcoin market, the altcoin season index is currently sitting at 43, which is neutral, but leaning towards Bitcoin dominance. This is not the time to throw darts at microcaps. Focus on assets with immediate catalysts. Keep an eye on the Ethereum ecosystem as developers finalize the scope for the Amsterdam upgrade, which promises massive scalability improvements. Also watch tokens related to the Clarity Act like XRP, as any positive news from the Senate Banking Committee could trigger a massive repricing. Remember, the fear and greed index is at 11. Extreme fear. Historically, these are the moments where smart money accumulates while retail panics. The rails are built, the institutions are here, and the regulatory fog is finally starting to clear. Manage your risk, stick to your levels, and do not let the short-term noise distract you from the macro trend. That is all for today's deep dive. If you found this analysis valuable, smash that like button, subscribe to Boni's Life, and let me know in the comments. Are you buying this dip or waiting for lower levels? Until next time, stay sharp, trade smart, and I will see you in the next episode.